Hi, everyone, and welcome to the week ahead. I'm Tony Nash, and I'm joined by Nick Glinsman, Albert Marco, and Tracy Schuchart. Before we get started, I'd like to ask you to subscribe to our YouTube channel. It helps us with visibility, helps you get reminded of our new episodes. So please do that while you're thinking about it. This week was all about the Fed, of course. We expected Monday and Tuesday to be choppy. We told you that on our last week ahead, which they were. We talked about it last week. We talked about the Fed meeting last week. And as Wednesday got closer, it appeared that Powell would be more bearish. And that seems to be exactly what we got. So today, we'd love to focus on a few things. Nick, let's start with you. What were your main takeaways from the Fed?
Okay, I've got three takeaways, most of which came after the Fed. Okay, the statement was sort of bland, almost appalling, in terms of it felt like it was leaving the risk markets to determine the Fed's policy. And then, boy, did Powell come out hawkish. He refused to give any direct answers, but never denied any of the points in the question, such as how many rates, however many it takes. So what was interesting is today we had the first Fed speaker, Neil Kashkari, the Uber dove of the FOMC.
That's right.
Right? And he basically came out and said, whatever it takes, we've got to get inflation. So, I mean, shocking. Now, where Powell got confirmed in his hawkishness came today with the ECI data. The base figure was slightly less than expected, but lift the bed sheets up and you are seeing major wage pressures. If you look at some of the increases in wages and salaries, 4.5% for all civilian workers, 5% for private sector workers, up from 4.2 and 4.6 in the third quarter, respectively. If you go deeper, hospitality, healthcare, you're looking at 7 and 8% increases.
Okay, healthcare nurses, in many cases, are making as much as doctors now in a number of hospitals.
Exactly. So that basically confirmed Powell's words of a rapid pace of wage growth. Okay, and I think that was a key thing. That was a very key piece of data, right, which in fact a bond geek like me would have been waiting for.
Right.
Now,
but we didn't see it in bonds today, did we?
What's that?
We didn't see the action in bonds today, did we?
They were down initially, and then they after the data they rallied a bit. But I think that was more to do with reversing a very successful week if you were well positioned. Okay. And what's interesting though, that came after that hawkish press conference. So typically, what you have is the yield curve mutually reinforces the relationship with the Fed's monetary policy. So simplistically, when an economy is strong and in danger of overheating, you are going to see the yield curve steepen, long end, higher rates relative to the short end. Now, that then reflects that the rates have to rise. That's the historical perspective. What was interesting this time was the curve was bear flattening, and it's headed towards an inversion, is the consensus. That's a really bad signal of an approaching recession. So that's, what it's basically suggesting is at that point historically, the bond market tends to suggest Fed's tightened too much, we're going to get a recession, it needs to stop, reassess, perhaps even cut. So what's startling about this whole move is you've got yield curve bear flattening coming so soon before the Fed has even started raising rates.
Right.
So if you have a swift move to inversion, it's going to be somewhat harder for the Fed to carry out its hiking program over time. That tells me that you're going to have it front loaded. It also suggests to me, which is what you got from Powell's press conference, it may not be 25 basis points each hike. It may be 350s. Ooh, right? Especially with this inflation. He was all about inflation and risks to the upside and a very strong labor market. So
350 basis point hikes. I just want to make sure we make sure that we know what you said.
Yes. Yeah. Basically what the yield curve suggesting that, but some of his comments were, this is a labor market that's rocketing. This is inflation that still has risks to the upside. We saw a bit of that today. He also said supply chains are not going to get resolved this year. We're going to have to wait till next year.
So, okay, so Nick, let's stop there because I want to ask you something, and this may be an overly simplistic way of asking the question, and Albert and Tracy jump in here. But it seems to me that what he's saying indirectly is, hey, there's supply side inflation, okay? And we as the Fed can't control the supply side. We can only control the demand side to some extent. And so what we're going to do is we're going to put a stopper on demand so that demand can come down to match up with the available supply. And that's how we're going to, we don't have the tools to put the kibosh on the supply side inflation. So we're going to bring the demand down. And so first of all, in general, does that seem to be what he's saying?
I think that's probably what he's trying to say, or
Okay.
what they're trying to express.
Yeah.
I would say, I would add one other point. So we were all thinking that, after the big rise in crude oil and energy prices last year, we would get some beneficial payback by the comparisons. Well, we're not. Oil's still going up. So
Right.
we're not getting that. And, the most extreme version is, for example, Europe. These have all got to feed through from wholesale to retail. And
Yeah.
I think it was 95% of surveyed American CEOs, I can't remember the sort of survey, but I can dig it out, are expecting to raise prices.
Yeah, the problem with them trying to limit demand though is it's going to start affecting jobs. The labor market's certainly going to weaken if demand starts to fall off.
This is
Because
the
wage
70s.
inflation is going nowhere. I'll tell you that right now. Wage inflation is here to stay. It politically is absolute, just not going to ever come back down. So that's going to be sticky for quite a long time.
But I think Powell was implying that where he basically said the labor market is super strong. So I don't disagree with it will dampen it. The question is whether it turns around. Remember, we're getting all these people retiring and dropping out.
Yep.
That was your data, Albert.
Well, I mean,
Yeah.
I would have to, he kept reiterating the labor market is super strong, but the labor market really, if you look under the hood a bit, it's not really super strong.
Absolutely.
We all know that.
That's true.
Yeah, agreed. But it's perceptions that, remember, these guys are basing their work off their forecasts. When have their forecasts have ever been right? Okay, even worse in Europe. So the point I'm making is they have their parameters, they have the data that they look at and monitor. And whether we agree with that data or not, and I mean, I would always disagree with the way the Fed measures, the BLS measures CPI, but it was impacted by Arthur Burns of the Fed in 1970s, right?
Sure.
So the point to be made is they have their data sets that they watch, and according to those data sets, they may be wrong. I don't disagree.
So just yes or no, because you're implying some things that 2 weeks ago we talked about, or last week we talked about. Yes or no, will we see Jay Powell's inner Volcker this year?
Yes,
We will.
in the short term.
Albert,
then he's
what do
going to
you
be
think?
stopped.
Yes or no, will we see Jay Powell's inner Volcker?
No.
Mini Volcker.
Mini Volcker, I agree with.
Okay.
A one and done, yes. One and done Volcker. A 1 week Volcker, yes, I agree with. Longer than that.
If he
One
does
and
a
done.
one and done, the bond market will riot. Like it was.
I love this.
If you look at the Fed meeting, no, but look at the statement. That statement said basically risk assets will determine the level of Fed funds, right?
Yeah.
Bond
yeah.
market sold off.
Okay.
Hold on. The bond market sold off aggressively. All across the curve, and particularly the long end. It didn't start to flatten in a bear manner until that press conference.
Okay.
Yeah.
Yeah, it was. So
that's
sorry,
all.
guys, let me stop you both just for a second. Tracy, will Jay Powell show his inner mini Volcker this year?
And I agree. I said this last week. I'm in the one and done camp, maybe 2, but I'm cutting it at there. I know Bank of America came out today and said 7, which I think they said the 7, yes, today, which I think I don't know what they're smoking exactly, but
Same guys who said $10.
I'll go with max. I'll go with max 2 on this one, even though I said one and done. I'll stretch that out maybe one more, but
Okay.
but that's where I stand on that one.
Okay, so while we're with you, Tracy, can you give us a quick view on what did markets get right and wrong this week from your perspective? Like, what do you think is a little bit out of whack?
Well, I mean, I think energy markets obviously remain elevated because of the Russia-Ukraine risk, right? Because Russia's, 10 million barrels per day. They produce a lot of gas. That's here with us to say we have a nor'easter. So, that kept a bid under at least the energy markets, right? And and I think last week we were talking about continued volatility all around in, say, the indices, and obviously, that trend has continued and probably likely will continue into next week. Again, I expect looking ahead to next week, I expect that it probably will still keep a bid under oil. But we did go kind of sideways this week, even though we got new highs. We're still, I still think we'll stay in that, 82 to $87 range, probably for the next week or so, until, and then probably get a little bit, if nothing happens with Russia and Ukraine, we'll get a little bit of pullback there. But, still looking at the overall fundamentals of the market, they remain very strong. So, I don't think we'll see any kind of material pullback.
Okay, this is on the commodity side.
On the
Or
commodity
equity
side.
Okay, what about the equity side?
As well, as far as equities indices are concerned, I think that we're again going to see continued volatility. What I think is, very interesting, as long as the market is pricing in rate hikes, that's going to put pressure on growth versus value, right? And so I think that trend will continue. I mean, I think we're in for a rough until that March meeting, until we actually hear an actual decision. This could be, we could be setting up for another volatile month in February.
Okay, that's fun, right? So, okay, so let's take that and let's swing over to geopolitics for a minute. And Albert, I want to ask you a couple things about geopolitics. Tracy mentioned Kazakhstan, which we'll get to in a minute, but has the White House told the Fed and Treasury that inflation is the top priority? Like, is that what you're hearing out of DC? Are they getting political pressure to make inflation their top priority?
Oh, absolutely. I mean, inflation is a nuclear bomb for politicians. I mean, gas prices rising, food prices rising. The job market is, they can say it's strong, but it's not. I mean, realistically, talking about 15-20% unemployment. So it's not strong. Right. So yeah, inflation is absolutely priority number one for the next couple months. Right.
Okay. And then as we move into a little bit more on geopolitics, so we got a viewer question from @77psychoeconomics. He says, has Russia's stabilization of Kazakhstan increased their influence over energy exports to Europe? So give us a little bit of kind of overview of what you see happening in Kazakhstan. And then if you and Tracy can help us understand what's happening with the energy exports to Europe, that would be really helpful.
Yeah, I mean, Kazakhstan's been stuck between Russia and China for a couple years now, but realistically, that's Russia's backyard. They control the area. Ever since the United States was booted out of Uzbekistan, they've lost a lot of sway in the region. So the energy sector from Kazakhstan all the way to Turkey and into the Mediterranean is pretty well dominated by the Russians right now.
And I would agree with that. And I'd also like to mention, just as an energy producer, I mean, Kazakhstan doesn't produce all that much. So if you're looking at the commodity side, I would say Ukraine would have more of a dent because of their how much they're involved in the cereals markets, how much they export in the cereals markets, how much they export in the uranium market. So that's definitely more commodities heavy area that I would be concerned about than Kazakhstan, just from the energy standpoint.
Yeah, and And when you're looking at Russia and talking about energy, it's not necessarily you don't single out just Russia's energy production. They go out and they meddle everywhere they possibly can,
Yeah.
whether it be Libya, Kazakhstan, Turkey, everywhere they can to sit there and depress those energy exports so they can pump out theirs. So that's what I mean by Russian dominance in the sectors.
Sure.
Will Russia attack the Ukraine? Albert?
Well, I mean, you're looking at you're looking at maybe 10, 20,000, conscripts that Russia probably hasn't paid in a while to go and loot the countryside of Ukraine, where that's already Russian dominated speakers. I mean, the Biden comes out and talks about sacking Kiev as if it's Hannibal on the gates of Rome. I mean, this is just an absurdity. I mean, Russia has no military, nor does it even want to go into Kiev and hold it. What's the point of bombing the thing? Of course they can go in and destroy Kiev if they wanted to overnight, but that serves absolutely zero purpose. So are they going to invade? Yeah, I mean, I would give it a 60-70% chance, but would it be something, some big kind of like issue? No, the market is looking at this issue as if it was World War III, and it's just, it's nothing more than a little bit of a skirmish.
But Albert, that's kind of kinetic, but they've already invaded the economy. They've already invaded any investors who want to go into Ukraine. That nobody's going to touch Ukraine for at least the next year, right?
Well, Tony, listen, I've been to that region, worked there for years in Georgia and the Ukraine.
Yep.
I mean, Ukraine has corruption issues,
Of course.
aside from the Russian problem, right? They've got legal framework problems and corruption problems that it makes investing there quite difficult.
Right. So, okay. So you're saying no, not going to happen. You're saying maybe some looting in Eastern Ukraine, but
They'll reinvade the same areas that they did in 2014. They'll make Biden and the West look inept, and that's their goal. That's it.
great. Okay. Sounds fun. So, okay. As we look ahead, guys, what milestones are you looking for the week ahead? Nick, what are you expecting to see next week in markets?
I'm fascinated to see the next bunch of Fed speakers come out. If we had the Ubadov very hawkish, that's as hawkish as he's ever spoken, Kashkari. I'm fascinated to see what the others are going to say. I think I can't get a handle on is whether this is a genuine bear market inversion or flattening going on in the bond market. I think I still maintain the point that you've got to look at the market and watch what's going on. Okay, so I'll be interested to see whether that continues. If it doesn't continue, that tells me that it was actually a bit partly people reversing bad positions on the yield curve, because really traditionally we should be having yield curve steepening. And then next week, well, we've got unemployment coming out on the Friday, so that's going to be pretty fascinating. And then we'll have the following week all that inflation data starting to come through, and we won't have the favorable comparisons from a year ago. Right. So it's going to be very, the banks have all jumped on, like Tracy said, Bank of America, 7 hikes. Goldman is 4 to 5 hikes. So they are jumping on this. This did surprise the banking community, with maybe the exception of Goldman, who came out beforehand and said this is what he was thinking. So it's a pull and push between what we've just been discussing. How many hikes? Have we got a mini Volcker building up here in the Fed? If he's got the support of the White House and Treasury, then maybe we have, right? I think that he had to have that before he came out with that sort of hawkish speech. So the question, I looked at today's equity market. That, to me, that started off as okay, let's cover the shorts because we've had a good week, and there's no liquidity. So the market just carried on popping up. Be interesting to see what happens on Monday. And remember, we have new lunar year holiday in the Far East. So the Far East is shut, as it were.
Right.
So even less liquid.
Right. So Tracy, you've said for a long time that Yellen is a strong dollar Treasury Secretary.
Yes.
And, so what Nick is saying about the Fed and the Treasury and the White House being in sync, it seems to make sense if they're tightening that is certainly something that Yellen might want.
Obviously, you're going to see a strong dollar. The Fed's raising rates. They're taking, liquidity out of the dollar market, right? And so we are going to, so in that environment, we are going to see a rising dollar. What we should be looking at, though, is emerging markets, right? How does this, that nobody's really talking about, is how does this affect emerging markets, emerging market debt that's denominated in USD? As the dollar gets higher, that puts pressure on emerging markets, even though, a lot of banks came out and said emerging markets should do better this year than DM markets. But in my opinion, not in an environment where we see, a rising US dollar. So that's something to look forward to.
And
I second that opinion.
in
Tracy.
the biggest emerging market, we saw the euro really taken to the shorts this week, right? So the euro is really problematic, and it's probably the newest of the emerging markets, in my view. So, so they've got real problems. But yeah, I think watching emerging market currencies is something that we really need to do over the next probably month to see how dramatic, will the shift that we saw this week, will that remain, and will that get even more dire? I think it will.
Yeah.
So, and Albert, what are you watching for the next week?
I mean, I have to reiterate what Tracy just said. Literally, I mean, it's the US dollar in the first half of the week, and then this bonds the second half of the week. I think if the US dollar gets over 98, it's a real problem for emerging markets.
Oh, yeah.
Especially, I mean, the Europeans kind of, and you're talking about the euro, but the Europeans like the euro suppressed right here because it's boosting their manufacturing sector. So it's a give and take with them. But the dollar gets over 98, start looking at problems.
Well, and my big question is this: when will the CNY break? When will they finally say, Uncle? And I've been saying for a while that it'll happen after Lunar New Year. They just can't keep this up, and with an appreciated dollar, it becomes even harder for them to keep that CNY at 6.35 or whatever it is, right?
Did we see a few little twitches of weakness today and yesterday?
We did,
didn't
yes.
we? Yeah.
We did.
Yeah.
So it's
Just remember, Tony, October is a big meeting for the party in China.
Yeah.
And they're going to have to, they are going to stimulate that economy sometime this year.
Oh, yeah.
It's just a matter of when it starts. And when you're talking about the currency, that's going to be a problem they're going to have to tackle pretty quickly.
Well, it's monetary policy, Q1, Q2, and it's a lot of spending in Q2, Q3, right? And Q4.
Absolutely.
But it's they're going to play with the currency in Q1, Q2, and play with the triple R and all this other stuff in Q1, Q2. And then in spending is going to rip starting in June.
Oh, yeah. Full disclosure, I'm building big position in China names as we go here. So
I was like, and commodities will benefit from that as well if they start spending, right?
Yeah.
And you're going to see commodities rip as well, which also hurts the inflation picture.
I was going to say that will be a negative for the bond market.
Okay, guys. On that note, thank you very much. It's been great, and have a great week ahead. Thank you.
thanks.
Thank you.
Thanks, Tony.
Okay, good one, guys.
That was feisty.
That was
fun.
good. I like that.